Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Friday, March 27, 2009. We begin in New Zealand, where GDP data for the fourth quarter showed the economy contracting 0.9%, following a downwardly revised 0.5% decline in the third quarter. It's the fourth consecutive decline in economic activity. On an annual basis, GDP was up 0.2%. The main drivers of the decline were the manufacturing and wholesale trade industries. In a second release from New Zealand, the February trade balance showed a bigger than expected surplus for February. Imports fell sharply, mainly on the back of a large drop in the amount of oil and autos imported. The New Zealand dollar-US dollar pair fell in favor of the greenback today, pairing the gains the Kiwi saw yesterday. The move from high to low was about 100 pips and retraced about 50% of the rally we saw in this pair the previous two sessions. The 0.58 level is now resistance. In Japan, consumer prices, when taking out volatile food items from the equation, remained flat compared to a year ago for the second straight month. Economists are watching for that annual core rate to fall into negative territory as worries mount about deflation. When food and energy prices are excluded, the annual rate was negative for the second straight month, while the headline rate was also negative. Japan's retail sales plunged 5.8% in February from a year earlier, the sharpest decline since February of 2002. It was the fifth consecutive month that consumers have reined in spending and indicates that the recession in Japan is only getting deeper. Despite the weak data from Japan, the yen was up today, mainly as a result of the end of the Japanese fiscal year and the repatriation of yens to Japan. The euro-yen pair, for instance, dropped more than 400 pips from high to low, bringing the pair back to its level at which it started the week. The euro found support at the 129.40 level and was trading above the 130 level in late New York trading. The euro also slid heavily against the dollar, as Germany's finance minister warned that the euro could suffer if members of the Euro-zone fail to respect the European Union's Stability and Growth Pact. The pact says that countries are supposed to keep budget deficits below 3%, which could be tested if more fiscal stimulus plans are passed. The euro fell 300 pips to the greenback today, breaking below recent support and setting a new 7-session low. In news from the Euro-zone, the industrial new orders fell 3.4% in January, which was better than the expectations, though December's figure was revised to show an even bigger 8% decline for the previous month. On the year, new orders are down 34.1%, reflecting the deepening recession seen there. That too had a negative effect on the euro overnight. In the UK, fourth quarter GDP was revised down to show the economy contracting at a 1.6% annual pace compared to the third quarter and down 2% on the year. That shows that the fourth quarter was worse than expected. In a second release from the UK, the current account showed a bigger than expected deficit, dropping to a shortfall of £7.6 billion. The pound-dollar pair continued its slide that started in the middle of the week, falling to the 1.43 level in New York trading from a high near 1.45 to start the session. The pound was pressured by its worse-than-expected GDP data, as some economists had even expected perhaps an upward revision. Traders see a deepening recession in Europe and the UK and are reluctant to bet on their currencies in this environment. Pit against each other, the euro fell against the pound as traders see the Euro-zone economy weakening, but the ECB's response has been more gradual, and policymakers seem reluctant to adopt some of the more unconventional methods like quantitative easing to jumpstart the economy. The pair set a new intraday high near 0.9415 in European trading, and then slid about 150 pips to 0.9250 in early New York trading, where the pair found support. This was a 61.8% retracement of the run-up we saw during the middle of the week. In the US, consumer spending rose 0.2% in February, the second month in a row that personal spending has increased. However, the result was not as impressive as it was in January, which saw an upward revision to 1%, and this month's spending increase actually was more a result of increases in prices. The data suggests that consumer spending has stabilized, though the other half of today's release showed incomes falling by 0.2%. That will limit spending on big-ticket items, as consumers are still fretting about their income situations and the rise in unemployment. The Personal Consumption Expenditure Price Index rose 0.2% on the month in February, a bigger than expected increase. January's figure was also revised up to show slightly faster inflation. The annual core PCE, which excludes food and fuel and is the preferred measure of prices by the Fed, rose 1.8%, which was also higher than economists' forecasts. U.S. consumer confidence, as measured by the University of Michigan, rose to 57.3, which was higher than the preliminary release and is 1 point higher than February's figure. The future expectations rose, the current index continued to decline. The US dollar-Canadian dollar pair climbed higher today, setting a new high for the week at the 1.2445 level. That broke the wedge pattern we have been following this past week. The gains were consistent with greenback strength, as US stocks were lower today, as were oil prices, which pressured risk appetite to end the week. Still, the Dow Jones Industrial Index rose 6.8% on the week, marking the third straight week of gains for US equities. Other commodity currencies, like the Aussie and Kiwi, were also lower today. Next week is full of key releases. We begin the week with Japan's industrial production data. That will be followed by the US ISM Manufacturing Index and the Japanese Tenkan survey on Wednesday. On Thursday, the ECB will conclude its policy setting meeting, and Friday will bring about the US non-farm payroll report. Next weekend, also, leaders from around the world will meet at the G20 summit, and traders should watch to see if the idea to use the IMF's special drawing rights, a basket of dollars, euros, sterling, and yen, as a global reserve currency, perhaps gains any traction. And that's it for this week in the Forex markets. Thank you for joining us here at CMSFX.com. And from all of us here, have a great weekend.